In every asset class, inelastic demand is a warning sign. It means someone with deep pockets is buying because they feel they have no alternative. Gold has reached that point, and the implications for investors are enormous. Gold's price is no longer natural in the way most people were taught. It's not just about jewelry demand, Western investor flows, ETF speculation, and tiny changes in real yields. For the first time in modern history, the biggest buyers of gold are the ones who do not care what it costs. That single fact changes everything. It means gold is no longer primarily reacting to the marginal traders, hedge funds, or ETF speculators. It is reacting to central banks and sovereign institutions who run the monetary system itself. And they ray not buying gold as a trade. They ray buying it as insurance against the consequences of their own policies. Markets are telling the truth before policymakers do. Sometimes, markets tell the truth long before policymakers are willing to admit it. Gold's rise since late 2022 is one of those moments. Fast enough to demand attention, persistent enough to signal structural change, uncomfortable enough to create a quiet split in how central bankers talk about it. Some Western officials still insist gold is just another price on a Bloomberg screen. But in Europe and across the emerging world, more and more policymakers are hinting that gold's strength reflects eroding trust in the post-Bretton Woods financial order. To really understand what's happening, we need to stop obsessing over the sound bites and start watching what institutions are actually doing. That's where Societe Generale's Commodity Compass work on gold demand elasticity comes in, and why VBL on the Gold Fix Substack has been so important in interpreting it. What the elasticity data really says. SocGen takes quarterly World Gold Council data and estimates time-varying demand elasticity across jewelry, bars and coins, ETFs, and central bank flows. Their conclusion is simple. The relationship between price and demand broke during COVID and has not gone back to the old equilibrium. VBL's take on Gold Fix. This is quantitative proof of what practitioners have felt for years. The synthetic, Western-dominated paper gold market is losing its dominance over the physical market. Let's walk through each segment briefly. Start with jewelry, because it still behaves the way textbooks say it should. SocGen finds jewelry demand still has negative elasticity. Price up gives people buy less. Price down gives people buy more. During the pandemic, that sensitivity deepened. And as prices surged into 2024 minus 2025, jewelry volumes fell around 23%, very close to the roughly 20% decline model predicts with elasticity around minus 0.4. So there's no mysterious collapse in retail appetite. Jewelry is behaving like a normal consumer category. The key point is, jewelry is no longer the place where the gold price is decided. Bars and coins live in a different world. They ray physical, but they behave as investment instruments. That reflects fear, momentum, and distrust of the traditional financial system. SocGen's estimates show a positive elasticity of around plus 0.44 bars and coins in late 2025. In plain English, as the price rises, investors buy more, not less. They aren't selling into strength. They're chasing it, either because they fear missing further upside, or because the rising price confirms their belief that something is wrong with the monetary environment. Pre-COVID, this behavior was already emerging. COVID distorted everything, but now the pattern is back and stronger. VBL is right to call bars and coins and amplifiers. Once gold starts to move, this segment adds fuel to the fire instead of cooling it. The biggest change is at the official level. SocGen shows that central bank elasticity fell during the COVID shock, then turned positive, near plus 0.9 between 2023 and 2025. On a simple regression line, a 1% increase in price is associated with a similar percentage increase in formal sector buying. Some people misread this as central banks are momentum traders now. That's exactly backwards. As VBL emphasizes, central banks are not buying because the price goes up. They are buying in the same environments where the price is going up, because both are driven by a deeper diagnosis. The current monetary architecture is no longer fully trustworthy. Now add Deutsche Bank's language, which Goldfix highlighted. They describe central bank gold demand as inelastic, That means central banks aren't budgeting in dollars. They're budgeting in tons and ounces. They decide how much metal they need for the level of resilience they want, then create whatever domestic currency is necessary to buy it over time. In that regime, weaknesses might speed up buying. Strength might slow it a bit, but the target tonnage doesn't change. Price becomes a secondary variable. Now the ETF market. For about 20 years, gold ETFs were treated as the beating heart of price discovery. Western analysts acted as if ETF flows were the master switch. But Sagan's Granger causality tests flipped that story. In Europe, North America, and the rest of world bucket, it's gold price that leads ETF flows, not ETF flows leading price. Global ETF elasticity is close to zero. By and large, ETFs are now reacting to price, not setting it. In the West, ETFs have become a mirror, not a motor. In China, it's more interesting. Sagan notes that Chinese ETFs elasticity spiked to extreme levels in 2023 and have stayed volatile. VBL argues this is not meme-style speculation, but internal monetization. China is building domestic gold investment channels as part of integrating gold into its own financial architecture. Those ETF flows show households and institutions using gold as a store of value and stabilizer inside a system under credit stress and geopolitical pressure. This is structural adoption, not a quick trade. Since the early 1970s, the global dollar system has rested on three pillars: the dollar as the main trading and payments currency, U.S. Treasuries as the key reserve asset, the dollar as the main funding currency for global financing. These pillars haven't collapsed, but they have weakened. Alternative payment systems have emerged. Treasury issuance has exploded to fund persistent deficits. Political volatility in Washington has injected new risk into what was supposed to be the risk-free asset. The seizure and freezing of a major G20 nation's reservations brought a long-running concern into sharp focus. Reserves held abroad can be turned into political hostages. In that world, gold stops looking like an antique and starts looking like the only clean balance sheet left. Put all this together: jewelry, classic, negative elasticity around minus 0.4, behaving like a normal consumer good. Bars and coins, positive elasticity around plus 0.4, amplifying trends via fear and momentum. ETFs, global elasticity near zero. Western funds follow prices. Chinese ETFs reflect structural internal monetization. Central banks and sovereign entities, positive elasticity near plus 0.9 in 2023 minus 25, but effectively inelastic in metal terms, driven by strategic, long-horizon choices. Gold's price no longer expresses a single, unified demand curve. It expresses the collision of four ecosystems, one of which, official buyers, has a completely different objective and time horizon. That's what we mean when we say gold's price is no longer natural. This also explains the communication gap. The Federal Reserve has to treat gold as peripheral, just another misbehaving price. To admit it's a signal would be to admit that the system itself is being questioned. Some policymakers in institutions, like the ECB, are more willing to hint that gold's rise reflects a slow loss of trust in the dollar's dominance and in the stability of reserve currency regimes. But both sides are constrained. Neither can say openly gold is being remunerated as neutral collateral in a fragmenting order. Their actions, however, are clear: repatriating gold once happily stored abroad, expanding domestic vault capacity, raising gold from single-digit reserve shares towards higher levels. Doing this in a world where mining supply grows slowly and high-grade discoveries are scarce. If even a few major emerging market central banks decide their gold holdings are too low for a world of sanctions and capital controls, the extra tonnage they want will be far beyond what miners can quietly provide. That imbalance gets solved by one thing: price. So what does all this mean if you're an investor? If you hold physical gold, or you're considering it, you are no longer playing a game dominated by fast Western money that can flip overnight. You are in the same queue as institutions who expect the next decade to be defined by fiscal strain, geopolitical rivalry, and legal uncertain tired cross-border claims. They're not chasing performance, they're buying continuity. The path of the price will be noisy, but the underlying direction comes from a simple fact. The monetary order is slowly rotating towards collateral that cannot be printed, frozen, or canceled. Gold's rise is not really about gold. It's about the system around it. Gold is the mirror in which that system sees its own vulnerabilities. It's not a new fashion asset. It's doing what it has always done when confidence in paper is stretched. It becomes collateral of last resort in a world suddenly reminded that promises have limits.